Listen to a financial broadcast and you'll hear a dialect of arbitrage, derivatives, and yield. These terms often obscure the very mechanisms they're meant to describe, effectively walling off the strategies used to build significant wealth. Strip away the professional jargon, and the foundation of economics rests on simple cash flow. You have income, the money generated from your job or business, and you have expenses, the money you spend on rent, bills, and food. The difference between those two numbers dictates your individual scorecard. On one side are assets, valuable things you own, ranging from a smartphone or a car to real estate and businesses. On the other are liabilities, the debts you owe to others, like student loans or credit card balances. This scale shows the ultimate measure of your personal baseline, net worth. It is a strict mathematical equation. Take the total value of your assets, subtract the weight of your liabilities, and the resulting balance is your total wealth. When your income exceeds your expenses and your assets outpace your liabilities, you generate a surplus. In finance, this surplus is called capital. Capital is money explicitly set aside to grow a business or invest in the market. Balancing your income and expenses will keep you afloat. However, deploying capital is the specific action required to move from maintaining a household to participating in the broader market ecosystem. When you inject that capital into the market by purchasing stock, you are buying equity. You take on fractional ownership of a living business. This diagram illustrates how we measure the size of those businesses. The single puzzle piece represents one share. Multiply the price of that share by the total number of shares the company has issued, and you get the market cap, the total public price tag of the company. This helps establish the valuation, or the calculated worth of the underlying business. Once you own a piece of that puzzle, there are two primary ways it generates profit. First, if the business is booming, they may distribute a portion of their profits directly to you as regular payouts, called dividends, the percentage of which is your yield. Second, if the company grows, the value of your share rises. This is called appreciation, and selling for more than you paid collects capital gains. Of course, the math works both ways. If the company struggles, the asset undergoes depreciation. The total volume of value shrinks, and selling for less means you absorb a capital loss. Acquiring equity alters your position in the economy. You transition from a consumer buying a company's products to an owner whose personal wealth is directly tied to that company's performance. This chart tracks the chaos of millions of owners trading that equity simultaneously. The jagged jumps and dives represent volatility. When investors are optimistic and prices are rising, we call it a bull market. When pessimism takes hold and prices fall, it's a bear market. To survive this turbulence, investors use defensive strategies. They use diversification, spreading their capital across unrelated assets, so a collapse in one sector doesn't wipe them out.
They also use hedges, secondary investments designed specifically to act as insurance if their primary investment fails. Because defense rarely yields massive returns, traders turn to speculation, taking high-risk bets on how they feel a price will move, and arbitrage, the practice of buying an asset where it is cheap and selling it in a different market where it is expensive. To amplify those bets, investors use leverage and margin. They borrow capital from brokers or banks to multiply their buying power, hoping a small price increase will result in a massive payoff. Then there are the abstract tools. Traders buy derivatives, contracts whose value depends on the future price of an underlying asset. They also engage in shorting. This involves borrowing an asset, selling it immediately, and waiting for the price to crash so they can buy it back for pennies, return the borrowed asset, and pocket the cash. When these high-wire acts fail, the consequences are severe. If a leveraged stock drops too far, brokers issue margin calls, demanding immediate cash. If the trader can't pay, the broker seizes their pledged collateral, like a house or car. Ultimately, this inability to pay back borrowed money results in default. The trading floor is a psychological battlefield dressed up as a calculator. These intricate contracts are mathematical engines engineered to balance the human appetite for accelerated profit against the reality of total financial ruin. This web illustrates how no trade happens in a vacuum. This is correlation. The price movement of a single asset has a direct impact on completely different assets. A spike in oil prices can drag transportation stocks down, while pulling renewable energy stocks up.
When that web consolidates and competition breaks down, power concentrates. An industry controlled by just a few massive companies is an oligopoly. Total domination of a market by a single entity, leaving consumers with no alternatives, is a monopoly. Governments often intervene in these power dynamics. Authorities deploy subsidies, handing capital to specific industries, like farming or energy, to lower consumer prices, protect local jobs, or manipulate market outcomes. Scaling these interactions across borders leads to globalization, the technology-driven integration of national economies. This interconnected trade creates national imbalances. A country exporting more than it imports runs a trade surplus, while a country buying more than it sells operates at a trade deficit. Monopolies controlling supply, government subsidies dictating costs, and global trade deficits are the invisible architects that dictate the price of your daily life. Financial terminology provides a technical schematic for human behavior, risk management, and the movement of global power. It traces the entire life cycle of a single unit of capital. It begins as personal income, transforms into corporate equity, survives the volatility of the trading floor, and eventually scales outward to steer global trade. Understanding this vocabulary provides the orientation needed to navigate the global market, turning vague figures into the foundational blueprint of the world economy.